Okay, in the previous video, we discussed how 6% compounded over a year would more than double your account. And you can see that depicted here if one hypothetically started with $5,000 and you were in fact consistently returning 6% per month. After one full year, January of the following year, 2015, you would have just a little bit over doubling your money at 5,000 would be 10,000. Again, you can see just a little bit, $60.98. And again, as I promised, it's less than 25 pips per week. Now, I know it sounds a little too good to be true, being able to make just a little bit of pips like this for over a period of a week and still doing such a dramatic increase in your equity. And again, if you guys aren't excited about 6% per month and you don't think that is dramatic returns, then you obviously aren't really aware of what goes on in the investment world, because this is a phenomenal return. Okay, but that's assuming you're using a 30 pip stop, which is essentially what I like to see new traders do, because it gives you a little bit of a flexibility for allowing inherent price action. Because most of us, when we first start doing things, we're in a rush to do things, or we are a little lethargic or apprehensive, so we may get in at most of opportune time. We'll probably end up missing that as we develop as new traders. So I allow a 30 pip stop, and I actually encourage traders to use the 30 pip stop as an initial. If you're really green to trading, you could use a 40 pip stop, and that will give you a lot more cushion as well. Now, don't be discouraged because it will be considered a large stop in some people's eyes. It's all relative, really. But we're going to assume that 6% is understood here as a relatively achievable goal. Okay, and we're going to give you a case study to think about. I'm going to assume that the average person out there would require about $3,500 per month. It's U.S. currency. Okay, and I'm going to give you a hypothetical scenario. If one would have to require a income of $3,500 per month, my question to you is, if you're trading with just this goal in mind, 6% per month, aiming for 23 pips for the week as a net, it's less than 100 pips per month, allowing you a 30 pip stop. You're only risking 2% of your equity. Okay, looking at that as it relates to trading with a $5,000 account, even after 3 years, you still haven't reached that goal. Okay, now I'm doing this to show you realistically how you may encounter some lag time in your goals. That's fine as long as you're moving ahead in the direction of your larger, longer term goal. Every small incremental movement towards that goal is a positive. Okay, again, it's not a race, it's not a sprint. This is a journey. You need to be enjoying it as you go through it. Otherwise, you're going to make it an arduous task, and it's going to be just like the thing you're trying to escape now, that job. So now let's look at what I promised, going forward, that we would look at ways to make exponentially larger returns on our equity. And let's assume for a moment that you wanted to make a very respectable 10% per month. And we're not changing the amount of risk percentage-wise. We're going to keep it at 2%. Suddenly, just by expecting a larger 10% return, we would need to net 38 pips. Now, again, this is rather reasonable. There's nothing significantly, shocking about the level of pips that would be required to earn that. Okay, you're only risking $3.33 per pip. Okay, that's the gearing using the 30 pip stop. Over the course of 1 year, okay, your $5,000 would return a net balance of $15,692. Now, looking at that same model, that we would assume that $3,500 would be one's expected return per month to live. Okay, you'd have to have about $37,000 in your account to draw that out. okay, or at least to make that over the course of a year. Now, my advice is not to think that once you get to these levels, you can start living off the account and start drawing out funds in the amount that's shown here. What I'm suggesting to you really is that if that's what you're aiming for a monthly income, you have to have some money in your account. Okay, I'm referring to your savings account or your bank account to survive for the year and allow your money to build over the course of the 12 months. And then as long as you average around this same amount, obviously, you would be able to meet that annual salary requirement to live as a full-time trader. That's the way I teach it. That's the way I try to groom traders to leave the retail world of trading and just speculating for extra money, then moving into full-time trading. The 10% return it's a pretty solid return. There's nothing I can say bad about it. It does get you rich over a period of time. It doesn't do it quickly, but it does significantly increase over a period of time. If you look at what transpires over the course of 3 years, your $5,000 obviously would grow to about $170,000. Now again, this is assuming that you're not paying any taxes on it and you are in fact hitting 10% return consistently every single month. Now, as you start, obviously you may not hit 10%, and then there may be other months where you do better than 10%, okay? But overall, it should average out. If you're doing things consistently, it should do staying around that 10%. If you're looking at these returns here, less than 40 pips per week. And again, we haven't done anything to the 30 pip stop. Now the question is this. Assume for a moment that you can fine-tune your entries a little bit more precise. And over the course of this presentation and series, what every new and or aspiring for a trader wants to know, we're going to teach specific applications, concepts, and skill sets that will enable you to reduce the amount of initial stop loss that's required. We're going to assume for a moment that we can now reduce our stop loss initially to 20 pips. Okay? If we can take these same trades, 2% per risk, per trade rather, now we're trading with $5 per pip. Notice it's still 2%, $100 of our 5,000 equity. We're aiming to make $500 or 10% for the month. Notice the contrast here. We had moved from needing to require making 150 pips, now only down to 100 pips. Remember, it was 90 pips before, trying to make 6% return with 2% risk on 30 pips stops. Now watch what happens when we change it to 15 pips. Now I know many are thinking, whoa, 15 pips, that's a really small stop. Well, there's ways to do that, and we're going to teach you that in this course. But now look what happens. We're under 20 pips for the week. Under 20 pips, only needing to make 75 pips for the entirety of the month. Notice we didn't increase our risk. It's still 2%. The risk would be a loss of $100, still 2% of our net equity of $5,000 beginning balance. Again, aiming for 10% return. Now, this is where it gets interesting. Notice that these numbers and figures are not changing over here. The only thing I'm changing is the amount of initial stop loss that's required. Okay? We cut the total monthly pip expectancy from 150 in half down to 75 only by adjusting and spending more time on accuracy and reducing our amount of pip on the stops. So in other words, we cut our 30 pip stop loss in half to 15 pips. Now you're probably wondering, is it really possible to do that? Yes, it absolutely is. And we're going to give examples of that in this video. But for now, understand that it's going to take you a little bit of time to get there. So again, it's all about not rushing initially. You need to go to this model first. If you can't do this model, 23 pips per week, 90 pips for the month, using a 30 pip stop, don't think for a moment you're going to be able to do 15 pip stop loss trades. Okay, you got to be able to grow into it, and it doesn't take long to do that. It only takes a couple months. We're talking about 6 months. This is the amount of time that you would require, this whole 6-month bracket up here. If you can do 6% consistently over 6 months, the only thing you're changing is the initial stop loss amount. Because if you can prove to yourself and be consistent about the way you apply the concepts that we're sharing, the only thing you're changing is the math. Okay? You're reducing the initial risk in half from 30 to 15 pips. Nothing changes in your percent risk. Nothing changes in the dollar amounts over here. Okay? But your work that's required to do the trades and returns drop rather exponentially. But you actually build a lot more flexibility over here on this end, okay, in terms of monthly returns, and still never changing the total risk per trade. Now, let's go back and assume for a moment that you want to make a 20% return. Now we're entering levels that are very, very phenomenal. Again, with a 30 pip stop loss, you would need to make 75 pips. Now, if you've been a follower of mine for any number of years, in 2010, I came out with the idea that if we're aiming for 50 to 75 pips, this was the model I was teaching. Okay, but now we're going through the entire ICT library again. Now we're going to give you the amplified view. To make 20% return, okay, we're going to use the same model here. Assume for a moment that we could go down to reducing our initial stop loss to 20 pips. We moved from needing to make 75 pips a week to 50 pips per week. Notice we have not increased our risk per trade at all. 20% is still the expected goal. And using $5,000 as an equity base example, after 1 year, it's $44,580. In 2 years, it's $397,000. Now, at month 7, you're already at the level where you're making that hypothetical $3,500 to sustain yourself on a monthly basis. And again, I'm not arguing the fact that everyone can live on $3,500. I'm just using it as a case study. So please don't send me emails saying, well, I really can't afford to live on $3,500. I'm just using it as an example, guys. So don't make more of it than it really is. Now, for a moment, let's assume that we are able to, again, trim our stop loss order initial entries and reducing the overall risk to 15 pips. Now, again, we're going to be using a day trader's model for entry, okay, but still using a 30 pip stop. It was still respectable when you can do 75 pips. But for now, assuming that we can get very, very close to the marketplace and allow a 15 pip stop loss, what will happen is you reduce your total monthly pip expectancy to half again. So now we need to only make 150 pips. And we only need to make 38 pips for the week. 38 pips for the week with an initial stop loss of 15 pips. That's less than 3 to 1. Think about it. That's less than 3 to 1. One trade with a setup of less than 3 to 1 would accomplish more than this. Okay? So, now let's assume for a moment, going back to our original settings, we want to make 30% return. Now we're absolutely in areas where it's just unheard of for folks to make this. Again, looking at this, we would need to make 113 pips for the week or 450 pips per month. Now, I know most of you are saying, well, I can't make 450 pips per month. Well, you're probably right. Right now, as a new trader or developing trader, you probably can't do that. But using 2% risk and a 30 pip stop, you would need to make 113 pips per week. Now, looking at our example of trimming, 20 pip stop loss, we would need to only make 75 pips for the week or 300 pips for the month. Now, this is doable. You can still do 75 pips over a week, even with the low volatility we have right now. Currently in 2014, at the time of this recording, this is still doable. It's going to require some work, but still yet it can be done. If you go back over to our example again, assume for a moment that we could reduce our risk to, again, 15 pips. We only need to make 56 pips for the week, or 225 pips for the month. Notice that we're not increasing the 2% risk per trade. It still stays locked at 2%. But it's allowing us a larger dollar per pip risk and still maintain the 2% total risk per trade on the $5,000. Again, these numbers are not changing as we adjust the pip amount in terms of the initial stop loss. It just changes the expectancy on what you need to make to acquire 30% per month. Now, at 30% per month, your $5,000 will grow to $116,000. Now, again, going back to our $3,500 example of case study needing to make $3,500 to sustain oneself, you get into that region around the fourth month if you're able to do 30% return. Now, again, this is assuming that one can consistently, month over month over month, do 30% returns. My question to you is this: if you can make 56 pips for the entire week, okay, you'll hit this number every single month. You'll do it. The only thing that's going to change is your dollar per risk, initially on your trades. Now let's go and look at assuming that we had a 20 pip stop. Okay, 20 pip stop. And you run this across the entire 36-month example. Okay, you would need $5 per pip, which is 2%, $100 of the total equity used for that month. Returning 30%, it's $1,500. You only need to make 75 pips. Here's a question. We have a 20 pip stop loss. Again, don't be confused, but this is a notation. If you look at what we have here, this is denoting that the stop loss will be requiring 20 pips. Okay, so now 20 pip stop loss. If one were to make a trade with 1-to-1 reward to risk ratio, that means you would expect to make what? You're risking 20. You're hoping to make what? 20 pip gain. Okay? So now, what if you were looking for a 2-to-1 trade? That's 2 rewarded for 1 risked. You would need to make a 40 pip net gain on that trade. You're risking 20 pips. You're hoping to make 40. Now watch this. If you were doing a 3-to-1 trade, risking 20 pips, you would expect to make what? 60 pips, risking 20, aiming for 60. That's a 3-to-1 trade. Now here's another example. If you're trying to make a 4-to-1 trade, you're risking 20 pips to make 80 pips. 80 pips made on a trade that's only risking 20 pips is absolutely doable. It's going to take some time and study to find them, okay? But they're there. They're there every single month. They're there every single week. And sometimes, okay, you can catch them simply in a day trading scenario. Many times you'll have to require your trade to hold on to it for a few days to do that, but you can still do it, okay? But my question is this. If you're focused on doing these types of trades here, where I'm trying to make my 20 pips per day, or I'm trying to make my 15 pips per day, okay, this right here gets most people in trouble because they're trying to get in there every single day and try to make those trades to make these pips, okay? I give these examples here as models to choose from, because there's several scenarios that specific traders will find themselves comfortable in: position trading, swing trading, or day trading, or scalping. And that's what this is designed for. This is the scalpers mentality here, or day traders column. This is what you would need to make as a short-term trader, okay, or a swing trader here twice a week. And then for the weekly is like a position trader. You hold for the weekly range. And then obviously a long-term trader would be looking for the monthly moves. Okay, so this is all broken down with that mindset. You choose where you're going to be most appropriate in terms of what you're allowing your psyche to absorb. Most traders can't do day trading. Most traders you can't get in front of the charts because of jobs, because of other things that are an obstacle for them. But there's other ways to do this. Okay, and let's use the example that if you're looking for this scenario right here. Okay, we have the gearing is a 20 pip stop. That's what we're going to use, and we're only risking 2%, and we're aiming for 30% return for the month. That means we have to do essentially what? We have to find a trade that's 4-to-1 reward the risk. That will give us better than this. Okay, I'm just going to move this a little bit just to show you something, because right now it's saying we need to make 75 pips per week to get 30% return. If, well, yeah, that would be a wonderful return, wouldn't it? To get 32% return, you got to get 80 pips, and that would be that 4-to-1 scenario where you're risking 20 pips. Okay, let me just change this right now as we're talking about. To make a 20 pip stop loss, you're risking $5 per point or pip. 2% risk total is $100. You're aiming for 32%. That would equate to that 4-to-1 scenario. Okay, so if you do 4-to-1 reward to risk setups every single time you do a trade, you will be in the realm that's required, okay, to do one shot, one kill setups per week, and then you would hit 32% return. Okay, so now let's look at a chart and see what that looks like, and how those types of trades set up, and how we can find 4-to-1, 3-to-1 reward to risk scenarios, and keep our stop losses relatively tight. But before we do, let me do this. Let's go back and do our gearing for a 15 pip stop, and we'll use the same scenario of breaking it down what's required. Okay, so we're using a 15 pip stop. You would need to make 56 pips for the week. Okay, so 15 pips, reward the risk of 1-to-1, you would need to make 15 pips net. And 2-to-1 reward the risk would be 30 pips for 15 pips risk. 3-to-1 would be a 45 pip to 15 pip ratio. In other words, you're looking to make 45 pips gain for 15 pips risk. You're trying to aim and make 45 pips. 4-to-1 would give you 60 pips. Okay, you would need to make 60 pips for the 15 pips risk to make 4-to-1. And again, that would be better than this. So that's probably very close to this, and that's exactly what we have here. So you would need to make 60 pips per week, risking 15 initially with a 4-to-1 ratio, reward to risk, and you would hit 32%. Now, again, this is all we're dealing with. This is just math, okay? And this is how easy it is. It's not hard to come up with a strategy to get these ridiculous amounts of return. What makes it difficult is you got to be able to see how to do that in the charts. So let's go over to the market and take a look at how that's done. All right, we're looking at the British pound USD pair. Okay, and I have some lines on here that we're going to utilize, and I want to show you what we have. We're going to assume for a moment that you thought that this 170.60 level down here would be an important support level. Now, I know you're probably thinking, all right, Michael, you're already starting off with a cherry picking scenario. Trust me, I am not let's go out to a daily chart, and I'll show you where that 170.60 comes from. Okay, we are looking at the levels on a daily chart, and you see this old high back here? The high on this day comes in at 170.63. My concepts teach that we like to round our numbers to whole numbers, or if it's very, very, very tight volatility, in other words, the ranges are very tight that you're looking at current price action, we'll use the 5 numbers. In other words, we'll go between 20 and 30, we may use 25. Okay, between 30 and 40, we may use 35. So we like to round to round numbers or round to 5s. Okay, so if you're looking at a high on this day, let me see if I can get that thing. There it is. The high of 170.63. That's essentially 170.60 or 170.65. I elected to go with 160 simply because that's what I wanted to go with. If you wanted to use 160.75 as your support level, yeah, it would be nothing wrong with that at all. Okay, but that's where the 170.60 comes from. And simple support resistance teaches us that once this resistance level is broken to the upside, once price comes back down to it, we would reasonably expect a bounce or reaction at that price point. And it just so happens that we happen to get that today on Tuesday. And let's go back down to a 15-minute time frame. Okay, and what we're looking at is the start of a new day here. This is where Tuesday began. Okay, we had some consolidation, and the market drifted lower and traded right into that level right there, bang, right into it. The low on this this candle here, if I can get things to work with me. Okay, we got the low of 170.60. Beautiful. Okay, you may notice this little blue line here. Okay, and you may know this green line and this red line. We're going to talk later on in the series about this red line, and this line here and this line here basically are the times that I asked you in the previous video to mark out on your charts and study what takes place around those times of the day. Okay, price trades down into this level here. Okay, we're going to assume that you believed that this was a bullish area to expect a bounce. We're going to increase this so we can see it. Okay, so the level is 170.60. You always have to factor in the spread. Okay, and we're just going to add 5 pips just for slippage and traditional retail spreads on the British Pound USD pair. Okay, and that means that your limit order would come in around 170.65. So your entry would be around here. Okay, we're going to look at a scenario where you're buying on a limit. Once price drops down on this candle here, you're going to be buying that level. Okay, and what I just did, I just put a little tiny little rectangle in here. Now watch what happens. It'll show up over here. Little numbers will pop up. See that? See the 8, now it's a 9. There's 10. Okay, the range of the rectangle's height is now 10 pips. There's 11, 12, 13. And I lost it because we went into the little indicator box here. Let's see if I can, there you go. I'll gain some more ground not doing that. Okay, so there's 15 pips. So your entry would be at 170.65, and your stop loss would rest 15 pips below your entry, and that's right here. Okay, at 170.50. Price has to trade down to that 170.50 level to stop you out. Okay, so that would be the selling price, because whenever we're looking at data, that's the sell price. So as long as price stays above that 170.50 level, you would be in the trade. Now, this is where it gets interesting. We're going to zoom in. Okay, and now we're going to take this range. Okay, and what I'm going to do is I'm going to just move it over a little bit like that, just to differentiate. And I'm going to show you this would be from your entry. If you got out right up here at the top of the rectangle, that is a risk to reward of 1 to 1. Okay, we're going to take a step out farther. Okay, and that would be an exit point here. If you got out there, that would be a 2 to 1. Okay, you're gaining 2 for every $1 you risked. Okay, we're going to move that out farther. Now this is a 3 to 1. So you're using that same amount of pips. Okay, 15 pips now 3 times for 1 risk. This is a 3 to 1 reward risk ratio. We're going to go out one more step. 1, 2, 3, 4 gain to 1 risk. Okay, so it's a 4 to 1 risk to reward ratio. We have 1, 2, 3, 4, 5 ranges of 15 pips each. Okay, so that's 5 reward to risk of 1. So 5 to 1 reward to risk. Okay, and to get 5 to 1, you would have to get out at around 171.40. Okay, now we could go all the way up to the absolute high. Like that, and that would be 1, 2, 3, 4, 5, 6, 7, 8 to 1 reward to risk ratio. And I know you probably are thinking, man, that's incredible. Well, you'd be surprised if you'd learned the concepts that we're going to be teaching in this series. And for those of you that watched the initial presentation over the last 4 years or so, from 2010 on, you're going to get the amplification of that, which is what we're getting here. This is really where I want you to focus. Right here. You want this type of setup right there. You want that. Okay. You want 4 to 1, and that's wealth building. Okay. 4 to 1 builds millionaires. Notice also that inside of this day, just in Tuesday, okay, this is not a week, this is not a course of several days, this is just one day. Price came off that 170.60 level and traded all the way up with a range of 132 pips. Now that's a nice range. This is what you've probably been used to if you've been looking at Forex for a number of years. That's about the standard, a little bit more than standard daily range for the cable. Recently we've entered into a small little volatility squeeze where nothing's really going on in the markets unless, you know, 1 or 2 moves a week creates a significant move, and they haven't really been this significant many times. But this is an area where you could use that mindset of looking for 4 to 1 reward to risk. Okay, now I'm going to give you another drill. We talked about looking at the swing points and each candle's high and low, and the opening and closing of those 3 candles on each swing point, and drawing them out in time and looking at how the future reactions would occur around those particular price points. The levels I have on this chart here, okay, are rather important. We're going to go out to a weekly, okay, and the weekly chart, let's do this. Okay, what I've shown here is just in the recent days, I delineated the red line is a weekly high, which is here. Okay, this swing high. And all the green levels, with the exception of this one here, this one really should be red. So let's change that. That is a weekly level. Okay, and the green are simply going to be based on daily highs. Okay, and what you're looking at is daily highs and weekly highs and lows on both. Okay, and by doing that, this is the exercise. And you guys maybe remember this from the initial installment of Excellence of Execution by Inner Circle Trader. When I was giving those initial videos back in 2010, I did them silent. And now this is the amplification of it, the things that you were missing. By having this is a low here, this is a high here, it lines up. We have a high here, we have a high here, okay, we have a high here. The exercise I gave was that you want to buy support levels or daily lows or weekly lows and use a 20 pip stop with a 20 pip profit objective. So you're trying to find reward to risk of 1 to 1. Okay, and you want to sell weekly highs and daily highs with a 20 pip stop and looking to make 20 pips gain. Okay, and we're going to look at just simply the month of June to the present time of this recording, which is the 15th of July 2014. Okay, and we're going to highlight that just so we know where we're at in deference to what's typically shown in data. I just want to focus on just this little area, and I'm going to go off white with it, or change the background a little bit. Now I'm going to go down to a 15-minute time frame. Okay, and I want you to notice when we trade down to these levels here, okay, when we trade down into that level, okay, we're looking for a reaction, and you would be trading this reaction with the expectation of looking for a move of 20 pips. Okay, so when price trades down into that level, you would use that specific price point, and that would be 167.30, and the low, and let's zoom in a little bit, right in here. Price trades down into that level, which is identified by the exercise we just did, showing you how to arrive at them. The low is 167.20, so you're buying at 167.30. The lowest of the low it went was just 10 pips below it, so your stop was never hit using a 20 pip stop. And looking at 20 pips gain, you would be buying here and getting out right there. Okay, that's the exercise. That's all there is to it. Now again, the reason why is you're not trying to find profits. That's not what you're trying to do. What you're doing is you're trying to follow a consistent plan of action, and it's to show you how your mind is going to be trying to resist following the rules of being in a trading plan. Okay, but it's also going to teach you that you can find a lot of opportunities where things will line up for you, but you're also going to encounter days and opportunities where it doesn't work out for you. You will get stopped out for 20 pips, and you would do this in a demo account. Okay, it's also going to teach you that you're not going to trade every single day, but it will give you one trading setup per week. Notice the double lines here. See that? That's a Sunday. So this whole day here is one day, or Monday. This is Tuesday's action between the vertical lines here and here. Between this vertical line here and here is Wednesday's trading. This is Thursday's trading. This is Monday's trading. Okay? Using this example here, this is a resistance level, okay, delineated from the weekly chart. You would sell at this price level at 168.25, 168.25 right there. And your stop loss would be up here. So if you're selling at 168.25, price traded with a high, if I can get my little doohickey here to work with me. Let's get a little bit tighter. The range high on that is 168.44. So in here, 168.44. It's close. You may, depending upon what data feed you were using and what broker, you could have got tagged out. It could have very well taken you out. So that would have been an opportunity, even though it did pan out and move from that level 20 pips. It would have paid on that one. You could have very easily been stopped out. Okay, and that's an exercise for you to see what it's like to go through that adversity. Okay, and still see it still moving in the right direction. So here we have another example that's doing the same thing. You would be selling at 168.25 as price trades right up to it. Your stop loss, again, never touched. Okay, so up here's where your stop loss would be. 20 pip take profit. Right down here on this candle, you'd be filled. That's it. You'd be out. Okay, and you would simply move to the sidelines. Again, the other part of the trading exercise is you are taking specific surgical strikes and taking out pips. Controlled risk, controlled execution. You know where you're getting in at. You know when you're getting out at. You know exactly what you're doing, when you're doing it, why you're doing it, based on a specific price level that was delineated from a daily and weekly chart, which are the two highest important institutional levels to be paying attention to. Again, that being the weekly and daily. So we had an example of a buy during that week, and we had an example of a sell here for that week that would have panned out as a losing opportunity. We have a new week here starting on Sunday. Right on Monday, we have that first opportunity trade. Boom, sell into that resistance and then get your 20 pips, done. Okay, now you can now also fine tune this a little bit. We discussed how to make 6%, right? You can test this theory of making 6% with one trade per week by saying, okay, well, I'm not going to use a 20 pip stop loss and take profit at 20 pips. I'm going to use a 30 pip stop loss and aim to make 25 pips for the weekly goal. Yes, you're making less than your risk, but you're also aiming with the mindset to slowly develop into where you could potentially look to make that 30 pips for the 30 pips risk. Okay, and then you take this exercise one step further by saying, okay, well, if I can see these levels like this, why can't I take my stop loss and reduce it to a 15 pip stop? So now if you're selling on that level here, your stop loss is now, you see that? So that's how we will use these exercises going forward, okay, to groom you into doing the things that you need to be doing. Again, this is 1 week starting here. Again, you're going to let other trades pass by. You don't care about what the other market setups are doing. You don't care about that. Where are we at here? We already did one trade for, yeah, that was the Monday. So you would be done for the week if you're doing one shot, one kill mentality and developing that. Here we have another area here where we're looking for 20 pip stop. You'd sell that level at the figure at 170 even. 20 pip stop, never hit you. Does it pay you to 20 pips? Sure does. Boom. There's your one shot, one kill setup drill for that week. And it does give you another one right here that would have paid you again the 20 pips. But once you get it, you move to the sideline and you don't worry about it again. Here's two scenarios right here where it does it again. Your stop is obviously never hit, selling it at 170.60. And looking at your 20 pip target taken, right there, you would have got filled. Same scenario here for another opportunity. Obviously stop never hit, selling at the big figure. I'm sorry, at 170.60, paying you your 20 pips right there. Wonderful opportunity. Going into a new week, we have this Sunday here. All right, we have price trading down to this level here, buying the level. Okay, we're at a resistance and support level based on daily and weekly. The red line is a weekly. You would be buying here with a stop loss 20 pips below. This is where you would absolutely be taken out of the trade rather quickly if you took it at all. Okay, so that'd be a losing trade for you to actually feel what it's like to go through that. Here's an area where you'd be selling that same level because we traded right back up to it. Your stop loss 20 pips away. So you'd sell right at that 170 figure. Stop loss will be up here. Never hit. Does it pay you to 20 pips? Boom. Yes, it does. Okay. So you would recoup the loss you took here. You'd immediately right now be back to even for the week. Okay. And if you were looking to sell again that level here, you would take a loss with this exercise. If you were taking, again, it's assuming you take multiple entries. So you would, if you sold this level here, you'd be stopped out for your 20 pip loss. Okay, price comes back down. This is that same level again. You would be buying it now, again for the exercise. Price comes down to that level. You buy it at 170, big figure. Your stop loss is 20 pips below it. Never trades there. Does it pay your 20 pips? Yes. So now you took a loss here, recouped it here. You took a loss here, recouped it here. You're net even on the week. And you go out the week net even. That's a good exercise. That's a good learning experience for you that week. We go into a new week here. Move up to a level. Okay, you have a stop loss above that level, selling short, blows you out. 20 pips stop loss, done. Okay, you're out of the loss. So you start the week again as a net loser. We go up to another level. Notice it doesn't get to it right here. Fell short of it a little bit. You sell short on that level. Stop loss is above 171.80. You sell it at that price level. And does it pay your 20 pips? Yes, it pays you. Okay, so you recoup the loss you took here. Now you're even for this week. So there's 2 weeks you had no gains, but you're able to recoup the losses. Very, very important lesson. Price comes down to this example we showed earlier in the video explaining how to get the 4-to-1 scenarios. So this is where we're at right now presently. We traded up to that same level here intraday. Selling this level at 171.80 using a 20 pip stop. It never got tagged. Did it pay your 20 pips? Yes, indeed. Okay, so you're able to capture this one here and capture this one here using the trading exercises. And it's meant to develop your consistency of following a plan, regardless of whether it makes money every single time or not. You don't care whether or not if you get a trade every single day. You're looking for weekly and daily highs and lows. Once they trade there, boom. You just go back over your charts of recent price action, 2-3 months at tops, and go through those levels. Have them on your charts. Okay, delineate them in any color fashion you like. I use red for the weekly and green for the daily. It could be whatever you like. It doesn't have to be exactly how I'm showing it to you in terms of colors and thicknesses and all that. It's a matter of preference, what you want to differentiate those levels based on whether they're weekly or daily. And don't think too much about setting precedents over weekly being better than a daily for now. Just use the swing points and highs and lows that we discussed earlier in the video to build the basis for the initial steps in finding your excellence in execution. And until the next edition, I wish you good luck and good trading.